Christina has a host of questions about the Strait. We're going to get into all of that in a minute, but I want to go to your most recent note. You talk about the superabundance trends in the Western Hemisphere and the major reversion that perhaps we are looking at in the second half of the year here. You're forecasting or expecting we might get to $40 a barrel on WTI. Explain how we could get there.
Yes, well, hello. The key way we get there is by pumping prices up too much, and it accelerates the process of superabundance in the Western Hemisphere, most notably U.S. As of right now, the U.S. and Canada are running a surplus of supply versus demand in crude oil and liquid fuels around 7 million barrels a day. If prices don't go lower and shut that off, we're probably going to head towards 10 million barrels a day by 2028. It's not just crude oil. We have to export our corn, soybeans, and wheat. It's a wonderful thing of superabundance. It's just bad for prices. And what I think we just did is we reaccelerated that process with prices going up, and it has inklings very much of 2008. Crude oil peaked at 147, and by the end of the year, it was around 40. We are doing that right now, and I'll just give you one example. At the beginning of the year, we had pumps and then dumps and just Bitcoin and natural gas. And now that list includes gold, silver, platinum, palladium, iron ore, corn, and potentially U.S. Treasury bond yields. So the key theme is right now for the second half of the year, I think all those prices are going to continue to go lower.
Okay, but this is where, as a foreign policy nerd versus a finance nerd, I get annoyed.
Yeah.
Because the traffic in the Strait is hardly back to pre-war levels. So why are we seeing this confidence in the oil markets that these prices are going down? Why is it dropping so surely when the reality on the ground isn't really reflecting that yet?
Because we're finding out the one of the most significant bull markets in commodities is increasing elasticity. When prices go up, markets find ways around it. We're finding out that OPEC is becoming increasingly redundant. Now, the UAE has left, so they're going to be drilling at will. Iraq has threatened to leave. They want to drill will. So what's happened is it accelerated Mr. Trump's mantra of drill at will on a global basis. Now that includes Venezuela, U.S., Canada, UAE, Iraq potentially. So it's what's happening in the space. And what was before the problem was the key thing to remember is technology is bad for prices in crude oil on both sides of supply and demand. It's creating more supply and reducing demand. And this event, just like it did in 2022 when Russia invaded Ukraine, just adds fuel to those trends. So I look at it as, yes, we might bounce. There might be something really bad to happen in the Gulf. Maybe crude oil gets in there 80, but on a normal cycle, it goes back to 40. And one key theme to remember is almost every time you have swoons in crude oil, it happens with the stock market going down. And we have volatility picking up everywhere in the stock market. Just prices are still hovering at those levels. So if we get a little dip for a normal midterm year, that means everything goes down. Crude oil and copper are kind of next on the list in commodities.
It's adding fuel to those trends, David. Did you hear what he did there? It's adding a little bit of an oil pun there.
That's an oil pun, energy pun. I want to ask you about the president's comments on gasoline prices in specific. So this week he raised the prospect of us getting $2.50 a gallon gasoline once again. He's also had a very strong message to the gas companies, the gasoline companies, the energy companies themselves. Let's play a little bit of what the president has said, the anger that he's directing at those gas companies.
We are not seeing anything at the pump by comparison to what it should be. We should be, in my opinion, at $2.25. ExxonMobil, it's Chevron, it's Shell, it's BP. They're not reducing the prices commensurate with what's happening. We are doing a big investigation on it.
Mike, I'm going to go out on a limb here and guess you would say we don't have to do a big investigation on this. Why aren't gas prices lower as we see oil prices dropping?
Well, if he wants to do investigation, he should start with futures traders because those retail prices are spot on with the wholesale gasoline price. They're all going lower. He's right. But there's much more of a lag. Remember, that's retail. It's on the street what you pay. And then what we deal with crude oil, that's wholesale. The key theme, though, is I think he's right. Prices will go back down to where they were before the war, but now we're in summer driving season. That's when prices are typically high. So by the time we get the midterms, before the invasion, before the war in Iran, prices, the average price in the U.S. was running around $2.90 a gallon. Right now, it's $3.90. I think we go back down to $2.90. The key thing to remember, though, is every single time we've made those lows below 2 have coincided with a little bit of problem in the stock market. And that's what I'm really worried about for the second half of the year. I think he's going to get those lower prices, but if it comes on the back of the stock market, that is a potential thing he's not going to want for the midterms.
Mike, I also want to ask you about my favorite subject, which is gold. I feel like it's had an interesting 6-month run. And earlier this week, it dipped below 4,000 an ounce for the first time since last November after gaining for quite a few months in a row. Silver's also dropping. Do we know why? And what happens if interest rates go up this year? How is that going to impact the prices?
Well, that's part of the reason gold's starting to go back down. It was very precedent for the war. It peaked right before the war. But the problem with gold, silver, most notably precious metals, is they just went up too much. At the beginning of the year, gold reached its highest ever versus a Bloomberg Commodity Index. It was a 40-year high versus a 60-month moving average. And most significantly, versus a treasury market, the treasury bond market, it's right now the lowest, or treasuries are about the lowest in almost since 1980s, early 80s versus gold. So to me, gold put in a pretty significant high back in Q1, and it's probably going to be stuck in a range for years. That's usually how it works. The significance is, though, it just went up too much. And another thing to remember about precious gold and certainly silver is you're supposed to be selling when they're yelling.
Should have hawked my jewelry when I had the chance. Sorry, David, go ahead.
No, Mike, very quickly here, our bosses say Mike McGlone can talk about anything. He's an expert on so many things. You raised a rhetorical question in your piece, which is, what does the President of the United States want when it comes to energy prices? And I'm going to give you 30, 45 seconds to answer that. If you kind of try to analyze the psychology of him vis-a-vis the energy market, what's the answer?
Well, that's been my key theme all along, why prices will not stay up. They will go down because he's the leader of the world's largest energy producer, next exporter, and he needs prices to go down, partly because inflation is the #1 issue and affordability is the #1 issue in elections.